Internal sources of finance. Internal source of finance is the finance or capital which is generated internally by the business, unlike finances such as loan, which is externally arranged from banks or financial institutions. The internal sources of finance are retained profits, the sale of assets, and reduction or controlling of working capital. Retained profits or earnings are called the internal sources of finance for a business for the simple reason that they are the end product of running a business. The phenomenon is also known as plowing back of profits. Retained profits can be defined as the profit left after paying a dividend to the shareholders or drawings by the capital owners. Formula for retained profits or retained earnings equals net profits minus dividend or drawings. Characteristics of retained profit are: retained earnings are a long-term source of finance for a company because there is no compulsory maturity like term loans and debentures. Retained profits are also not characterized by fixed burden of interest or installment payments like borrowed capital. The advantage of having retained profits or earnings is clearly seen in its characteristics. First, they are long-term finance and nobody can ask for their payments. Secondly, since there is no additional equity to be issued, there is no dilution of control and ownership in the business. Thirdly, there is no fixed obligation of interest or installment payments. Fourthly, retained earnings as an internal source of finance are cost-effective considering the fact that there is no issue cost attached to it, which ranges between 2–3%. Lastly, investing retained earnings in the projects, with IRR better than ROI of the business, will directly have a positive impact the shareholders' wealth, and thereby the core objective of management will be served. Another internal source of finance is the sale of assets. Whenever business sells of its assets and the cash generated is used internally for financing the capital needs, we call it an internal source of finance for sale of assets. It can work as a short-term or long-term finance depending on what kind of assets are sold. Say, selling a car can cater short-term and smaller finance needs, and selling land, buildings or machinery can cater to long-term and bigger finance needs. Drawback of sale of asset method is, in this type of internal source of capital, is that the benefits of useful assets which are sold can no more accrue to the business. A possible and perfect solution to that situation is sale and lease back. Reduction or controlling of working capital. Normally, a business requires two types of finance, viz. long-term finance for capital expenditure and working capital finance for day-to-day needs. Reduction in working capital can be achieved either by speeding up the cycle of account receivables and stock or by lengthening the cycle of account payables. In essence, both will reduce the working capital requirement, and therefore, the funds invested for working capital can be utilized for the other finance or capital requirements. This source has a little different analytics. This source is generated out of the efficient management of working capital and appropriate usage of working capital management techniques. Thank you. Please subscribe, like, and share our video.